Good afternoon, everyone. A very warm welcome to all of you to yet another insightful session of the Brain Gain Expertise series organized by the Accounting Standards Board of the ICI. We are thrilled to have you join us today for a session on a technical topic of accounting for foreign currency transactions and translation of financial statements. This marks the ninth session in our valuable series designed to deepen our understanding of the practical application of accounting standards through expert led discussions and rich knowledge sharing experiences. We believe that today's session will provide you with the meaningful insights, practical perspective, accounting for, and enhanced clarity on the real world challenges related to foreign currency accounting and translation, a topic that continues to evolve in the global business landscape. We are privileged to extend a very warm welcome to our esteemed speaker for the day, CA Paras Kumar Chadda. Thank you for joining us, sir. Before we move into the technical session, allow me to briefly introduce our moderator for today's webinar, CA Kapil Kedar. Kapil Kedar is a qualified chartered accountant with over 25 years of experience in the field of assurance and financial reporting. He is member of Consolidation Group of AASB of ICI and participated in various publications of AASB. He has been eminent speaker at various professional forums, including seminars, webinars conducted by the Institute of Chartered Accountants of India. He is well versed with accounting standards, IGAP, Ind AS, and IFRS. I now invite CA Kapil Kedar, sir, to take the session forward by introducing our distinguished speaker for today, CA Paras Kumar Chadda. Over to you, sir.
Thank you, Rahul, and a warm welcome to everyone, my fellow colleagues and friends. And I thank you, Sanjeev Singhal, Chairman, Accounting Standard Board, and CA Vishal Doshi, Vice Chairman, Accounting Standard Board, and the ASB team for giving me this opportunity to be part of today's exciting session on accounting for foreign currency transactions and translations of financial statements, which inter alia will cover the IAS 21 and Indian GAAP 11 for accounting for foreign exchange transactions. And the key highlights of the sessions are going to be initial recognition and measurement of foreign currency transactions, treatment of foreign currency differences, translation of foreign operations, and disclosure requirements for foreign currency transactions and translations. And I'll now have the privilege to introduce our speaker for today's session, Paras Kumar Chadda. Paras is a qualified chartered accountant with more than 13 years of experience, and he has been working as senior manager in the financial accounting and advisory services, which is fast practice of EY. And he has completed his Ind AS certification course and BRSR certification course from ICAI. And Paras' core expertise lies in GAAP conversions, including from IGAP to Ind AS to IFRS to US GAAP, reviewing standalone and consolidated financial statements prepared under various GAPs, and doing the accounting and advisory services for complex accounting situations like hyperinflationary economy, accounting transactions, business combinations, etc. And Paras has also been regular in the various ICI initiatives, and he's a eminent faculty member of India as a speaker of the ICI for various seminars. And he has also been actively engaged in professional activities, serving as a registered technical reviewer on the panel of FRRB, Financial Reporting Review Board, and Research Committee of ICI. So without taking more time, I'll now request Paras to start the session for today's on the foreign currency
transactions. Thank you so much, Kapil, for such a warm welcome. So first and foremost, I would like to thank Sanjeev Singhal sir and Vishal Doshi ji and the entire team of Accounting Standard Board for giving me this opportunity to share my views on this extremely important topic, that is Ind AS 21. Second, I would like to thank all of you for taking this time to join this session. Now, I think without further ado, we should start our today's topic, that is Ind AS 21. Please let me know, Kapil, is my screen visible?
Yes, Paras.
Okay, great. So before directly jumping into the PPT of Ind AS 21, let me set the background. I am damn sure that you guys must have read the provisions of AS 11, right? And provisions of AS 11 talks about the presentation of financial statements in the presentation currency. If you read the provisions of Ind AS 21, there is significant difference between the provisions of AS 11 and Ind AS 21 with respect to particularly functional currency. There is no concept of functional currency in AS 11, but there is a concept of functional currency in Ind AS 21. Now, what is functional currency? Let's assume there is entity X Limited, which has been registered under Companies Act 2013 or 1956, as the case may be. And this company is carrying out its business in India, right? So it is assumed in AS 11 that INR will be the functional currency of this entity as well as the presentation currency of this entity. But on the other hand, if you read the provisions of Ind AS 21, you will get to know that it is not always possible that INR will be the presentation currency or the functional currency of this entity. It could be US dollar, it could be pound, it could be any other currency depending upon these facts, circumstances, and underlying transactions, right? So it is extremely important for us to determine the functional currency of the entity so that the entity can prepare its financial statements in functional currency. Along with the functional currency, entity is free to provide its financial statement in any other currency as well, and that other currency will be considered as presentation currency. So this is the main difference between AS 11 and Ind AS 21. Right. So Ind AS 21 basically deals with three issues. Number one, determination of functional currency. Number two, if any company has entered into a contract which is different from the functional currency, so that particular currency will be considered as foreign currency. So how this entity will translate its transaction of foreign currency into functional currency. And number third, if such an entity is having any foreign operation. So foreign operation could be in the form of branch, it could be in the form of subsidiary, associates, joint venture, right? So if such an entity is having any foreign operation, then how the financial statements of that foreign operation will be translated from its own currency to the presentation currency of the reporting entity. Mind you, here I'm talking about the presentation currency of the reporting entity and not the functional currency of the reporting entity. So basically, these are the three issues which we are going to cover today. So this is the agenda. First, we need to check the definition of foreign currency, functional currency, and presentation currency. Then we will discuss how to determine the functional currency because detailed guidance has been provided by Ind AS 21. How will you determine your functional currency? And then how to translate foreign currency transactions into functional currencies. So if any company has entered into any foreign currency transaction, how this transaction will be converted into the functional currency of the entity, because entity is required to prepare its financial statements by using its functional currency on a mandatory basis. Along with these financial statements, other financial statements could be presented in any other currency as well, right? Then next is what are monetary and non-monetary items and their recognition. Then how to translate foreign operations into presentation currency of the reporting entity. And in last, we will be discussing about the disclosure requirements and GAAP differences. So we are going to cover GAAP difference between AS and Ind AS as well as Ind AS and IAS, right? So this is slide number 1, which talks about the scope and definition. So if you talk about the scope, as I said, we need to understand the accounting for transactions and balances in foreign currencies. Because if you have entered into a contract in foreign currency, you need to translate that foreign currency into functional currency. But there is one exception here. Ind AS 21 does not cover the derivative transactions and balances which are covered under Ind AS 109. So for derivative transactions, we are having a separate standard, as we all know that is Ind AS 109. Therefore, derivative transactions does not fall under the purview of Ind AS 21. Now the question arises, what is derivative transaction? Although I am not going to dive deep into the derivative transactions, but just for the purpose of understanding, let me clarify you. Derivative transactions are those transactions where there will not be any initial significant investment, or if there is any investment, that investment would be insignificant. Second, these transactions are required to be settled at future date. And generally, these transactions are settled on a net basis, right? So these are the indicators through which you can identify whether it is a derivative transaction or not. And if you talk about the examples of derivative transaction, it covers forward contracts. It covers foreign currency purchase contracts. It covers call option, put option, interest rate swap. All these are the examples of derivative transactions, right? So this is scope number 1. We are going to cover the accounting for transaction and balances in foreign currencies. Second, foreign operation, we have already discussed. We need to translate the results and financial positions of foreign operations into the presentation currency of reporting entity. And third, last, we are going to talk about the presentation of financial statements in foreign currency. So this is the scope. Ind AS 21 does not apply to following transactions as well. Ind AS 21 does not apply on derivative contracts as well as on the following items. Number 1, hedge accounting. Again, Ind AS 21 is not applicable on hedge accounting. Why? Because we are having a separate standard, that is Ind AS 109, which deals with the hedge accounting transactions. Second, presentation of cash flow. If you are generating your revenue in foreign currency, or you are going to incur your expenditure in the foreign currency, how you are going to present these in the cash flow statement, this issue has been specifically dealt with in Ind AS 7. Therefore, Ind AS 21 does not talk about it. Then last one is long-term foreign currency items for which an entity has opted for exemptions as per Ind AS 101. Such an entity may continue to apply the accounting policy as opted for such long-term foreign currency monetary items. So this is para 46 and 46A of AS 11. For the time being, I am skipping this part and I will be discussing this point once again towards the end of the session, when I will be discussing the GAAP differences between AS 11 and Ind AS 21. Then I will discuss this point, because this will take a lot of time to discuss, right? So for the time being, I am parking this point. Now we are going to cover the definition. First, presentation currency. So as I said, presentation currency is the currency in which financial statements are presented. Let's assume there is entity X Limited, and this the functional currency of this X Limited is US dollar. For the time being, let's assume the functional currency of this X Limited is US dollar, and this X Limited is registered in India and is carrying out its business in India. If this entity wants to present its financial statements in INR, so INR will become the presentation currency of this entity, right? If this entity wants to present its financial statements in euro or pound, then euro and pound will become the presentation currency of this entity. So in nutshell, we can say the currency in which the financial statements we are going to present will become the presentation currency of the entity. Second, foreign currency. What is foreign currency? Foreign currency is nothing but a currency other than functional currency. So as per my example, if dollar is the functional currency of the organization, then any currency other than dollar will be considered as the foreign currency of this entity. And third, this is functional currency. What is functional currency? Functional currency is the currency of primary economic environment in which entity operates. Now, if I say in the simple language, functional currency is the currency in which entity performs its functions, whether it is revenue, whether it is about raising of funds, whether it is about incurring the expenditure. The currency in which entity is going to perform its function will become the functional currency of the entity. Although the detailed guidance has been provided in para 9 and 10 of Ind AS 21. So now we are going to talk about the determination of functional currency, right? Para 9 talks about the primary indicators and para 10 talks about the secondary indicators. So if you are able to determine the functional currency of the entity by applying the parameters given in para 9, then there is no need to apply the provisions of para 10. But in contrast, if you are not able to determine the functional currency of the organization by applying the parameters provided in para 9, then you will have to apply the provisions of para 10, right? So in primary indicators, first point talks about the currency that mainly influences sale price of the goods and services. The currency which is mainly influences the sale price of goods and services will become the functional currency of the entity. Let's assume there is entity S Limited that is the subsidiary of H Limited. This S Limited is registered in India and is carrying out its business in India. But the H Limited, which is the holding company of this S Limited, is situated in US. And US dollar is the functional currency of this holding company. Now, what is happening? Holding company is only providing goods to the subsidiary company for the purpose of making sale in India. And whatever is the collection, the subsidiary company is going to remit that collection to the holding company. In my example, although the X Limited is registered in India and is carrying out its business in India, but the sale price is influenced by US dollar. Why? Because it is holding company who is going to provide all the products to the subsidiary company for the purpose of making sale in India. And the the sale price is decided by the holding company itself. So it is US dollar who is going to impact the sale price of the X Limited and not the INR. So as per my example, although the S Limited is registered in India and carry out its business in India, but the dollar will be considered as the functional currency of this S Limited and not the INR. This is point number one. Second, currency of the country whose competitive forces and regulations mainly determines the sale price of its goods and services. Again, you need to check the currency of the country whose competitive forces and regulations mainly determine the sale prices of goods and services. If it is US, then the US dollar will be the functional currency of the entity. If it is India, then INR will be the functional currency of the entity. Third point talks about the currency that mainly influences labor, material, and other costs of providing goods and services. In point number 3, they are talking about the labor, material, and other costs. So in nutshell, we can say that this is nothing but the operating cost. We need to check which currency mainly influences the operating cost of the entity, whether it is INR or whether it is any other currency. The currency which mainly influences the operating cost of the entity will become the functional currency of the entity. Right. So in nutshell, after reading all these 3 parameters which have been provided in primary indicators under para number 9, we can conclude that we need to check the trading account of the entity. बचपन में हम trading and profit and loss account बनाया करते थे. So we need to check the trading account, which currency is influencing the sale price and which currency is influencing the operating cost of the organization. And on the basis of these parameters, you need to identify the functional currency of the entity. It is quite possible that after applying these parameters, you are not able to determine the functional currency, because it is possible that there are 2 currencies who are influencing the sale price and operating cost. Let's assume INR and US dollar. Both the currencies are impacting the sale price and the operating cost. So what you need to do in this case? In this case, you will have to apply the provisions of para 10. You will have to apply the provisions of para 10, or you can say secondary indicators, right? Secondary indicators talks about the currency in which funds from financing activities are being generated. So you need to check in which currency promoters are infusing their capital in the entity, in which currency shareholders are infusing their capital in the entity, in which currency the company is raising its long-term loans, right? Whether the company has issued any preference share capital, any bonds, any debentures. If yes, then what is the currency? It is INR or something else, right? In which currency the company has taken working capital loan, in which currency the company has taken long-term loan. So all these criteria regarding the arrangement of funds you need to check. Then second point talks about the currency in which receipts from operating activities are usually retained. Again, we can say in the currency in which working capital requirement is being met by the organization can be considered as functional currency, right? So these are the 5 indicators basis which you need to identify which currency is the functional currency of the entity. I have been asked one question multiple times, that do we need to satisfy one criteria, one parameter only, or do we need to satisfy all the 5 parameters which have been provided in para 9 and para 10? So let me clarify you here. You need to satisfy majority of the criteria, right?
Out of 5 criteria, you need to satisfy at least 3 criteria in order to determine the functional currency of the entity. If 3 criteria are in one favor and 2 criteria are in another favor, then you can conclude that the currency which are impacting the 3 criteria can be considered as functional currency, right? I hope I was pretty much clear on my thoughts and you guys were able to understand all the parameters as we discussed, right? Now let's solve example number 1, which will give you more clarity. So question says A Limited is in the business of selling energy drinks and sell its product globally. From the total sales of A Limited, 85% sales comprises of sales from energy drink. The selling price is determined on the basis of local currency, that is INR. So on the basis of the facts given, the local currency of this A Limited is INR. Further, the question is saying, however, for convenience and consistency in pricing, A Limited denominates its sales in USD currency. Though A Limited generally holds USD cash reserves, but the financing activities and other costs are mostly incurred in INR. You are required to determine the functional currency of A Limited. Now, after reading this question, we can conclude that 3 criteria out of 5 criteria are being satisfied in the favor of INR currency. How? Let's evaluate. Selling price is determined on the basis of local currency, that is INR. This is the main factor which you need to always check which currency is impacting the selling price of the organization. In this case, INR is impacting the sale price. Further, the question has mentioned only for the purpose of convenience and consistency, A Limited denominates its sale in USD currency. It doesn't matter for us. Why? Because only for the purpose of convenience and consistency, A Limited is generating its invoices in USD, right? Further, A Limited is holding the cash reserves in USD, but financing activities and other operating costs are mostly being incurred in INR. So we can conclude that INR is the functional currency of the organization. Let's read the solution. It says in the given scenario, INR is the currency of the country whose competitive forces and regulations mainly determine the sale prices of its goods and services. Further, significant portion of costs are in INR and sales are denominated in USD currency only for convenience and consistency in pricing. Further, the solution is saying financing activities also done in INR. This can further support the conclusion that functional currency of A Limited is INR and not USD, right? Now let's read about the determination of functional currency in case of foreign operations. First of all, you need to apply the provisions of para 11. Always remember, in case of foreign operation, first you will apply the provisions of para 11, and if you are able to identify the functional currency of the foreign operations by applying the provisions of para 11, then there is no need to apply the provisions of para 9 and 10. However, if you are not able to determine the functional currency on the basis of para 11 in case of foreign operations, then you will have to apply the principles of para 9 and 10 in order to determine the functional currency of the foreign operation. So first you need to check whether the functional currency of the foreign operation is same as that of the reporting entity or not. If all these, or you can say if majority of these criteria are being satisfied by the foreign operation, then you can say the functional currency of the foreign operation is same as that of reporting entity. And if these criteria are not being met by the organization, then you will have to apply the provisions of para 9 and para 10 in order to determine the functional currency of the foreign operation, right? Now let's read all these criteria one by one. First, it says whether activities of foreign operations are carried out as an extension of the reporting entity rather than being carried out with a significant degree of autonomy. What is the meaning of significant degree of autonomy? Ajadi. हमने भी 15 अगस्त को आजादी मनाई. You need to check whether this foreign operation is ajad or not. If it is ajad, if it is having significant degree of autonomy, then we can conclude the functional currency of the foreign operation is not same as that of reporting entity. But in contrast, if the foreign operation does not have significant degree of autonomy, means foreign operation जो गुलाम है अपनी holding company का, then we will conclude functional currency is same as that of reporting entity, right? So you are required to evaluate the significant degree of autonomy. Now, how will you evaluate? You need to check whether the foreign operations can make its own decision by own, whether any significant interference is there or not with respect to making the decisions by this foreign operation. If the foreign operation is seeking the consent of the reporting entity for making each and every decision, then we can conclude this is not independent entity. There is no significant degree of autonomy. But in contrast, if the foreign operation can make its decision on its own, then we can say, okay, significant degree of autonomy is there, and the functional currency we need to determine on the basis of para 9 and 10. Second point, whether transactions with reporting entity are a high or low proportion of the foreign operations activities. So you need to evaluate in second point, what is the volume of transaction between the foreign operations and the reporting entity, whether the foreign operation is dependent on the transactions with the reporting entity. If answer is yes, then we will say foreign operation is dependent on the reporting entity, and hence functional currency would be same in this case. But if there is low proportion of transactions, then we can say the foreign operation is running its business independently, and we need to evaluate, we need to determine the functional currency of the foreign operations on the basis of para 9 and para 10. Third point talks about the cash flows of the activities of foreign operations, whether the cash flows of the foreign operations are directly affecting the cash flows of the reporting entity. If answer is yes, then we can say foreign operation is dependent on the reporting entity, and in that particular scenario functional currency would be same of both the entities, right? But if the cash flows of the foreign operation is not impacting the cash flow of the reporting entity, then we can conclude, okay, this is the business which the foreign operation is carrying independently, and we need to determine the functional currency basis the provisions of para 9 and 10. Then fourth point talks about the cash flow activities regarding the foreign operations, debt obligations, and meeting the working capital requirement. So you need to check whether the cash flows are being generated by the foreign operations in order to survive and in order to meet their debt obligation. If answer is yes, then we can conclude the foreign operation is working independently. But if answer is no, foreign operation is dependent regarding the fund arrangement on the reporting entity, then we can say the functional currency would be same for both the entities, right? So after evaluating all these four parameters, you need to check whether the foreign operation has significant degree of autonomy or not, whether the business of foreign operation is dependent on the reporting entity or not. If we conclude there is significant degree of autonomy and the foreign operation is carrying out its business independently, then you need to determine the functional currency of the foreign operations on the basis of para 9 and para 10, that is primary indicators and secondary indicators. But if we conclude that there is no significant degree of autonomy and the foreign operation is not carrying out its business independently, then we can conclude in this case the functional currency of the foreign operation will be same as that of reporting entity, right? Now let's read example number 2 to gain better understanding. It says parent limited exports from India steel products to major steel makers globally. For this reason, it has set up its subsidiary Sun Limited in Australia. Sun Limited undertakes orders from customers in Australia and supplies the goods received from parent limited. Also, Sun Limited collects the proceeds from Australian customers, which are always in Australian dollar, and remits it to the parent limited, right? Apart from this, Parent Limited manages whole of the funding, including administration and other expenses of Sun Limited. There is no other role being played by Sun Limited. This line is extremely important. The question is saying there is no other role being played by Sun Limited. What the Sun Limited is doing? Sun Limited is receiving products from its holding company and it is selling those products in Australia, and whatever is the collection, the Sun Limited is remitting that collection to its parent company, right? And parent company is also managing the funds for the Sun Limited, right? There is no other role being played by Sun Limited. So, basis these facts, we can conclude that Sun Limited is dependent on the parent entity, right? So, the functional currency of the parent entity will become the functional currency of foreign operation as well, right? So, question is asking, in this scenario, you are required to determine whether functional currency of parent limited, that is INR, can be considered as that of subsidiary Sun Limited. So, answer is yes. Let's read the solution. It says, in this case, Sun Limited does not have significant degree of autonomy, as operations which are being carried are simply an extension of operations of parent limited. Therefore, currency Australian dollar cannot be considered as functional currency of Sun Limited. In this scenario, currency of parent limited, that is INR, will be considered as the functional currency of Sun Limited as well. I hope this question is clear to you. Now, moving forward towards the identification of monetary and non-monetary items and their recognition. Why we are gonna identify monetary and non-monetary items? Because accounting treatment is different in Ind AS 21 for monetary items and for non-monetary items, right? And therefore, it is important for us to determine which transaction is monetary and which transaction is non-monetary. So, Ind AS 21 says, if you read about the monetary assets, it says monetary assets are those items which will be received in fixed or determinable amount of cash. I am reiterating myself. Standard says monetary assets are those items that will be received in fixed or determinable amount of cash. For example, cash and cash equivalent. If any entity is holding 10,000 US dollar, then that amount is fixed in cash, right? And that can be considered as monetary assets. Second, accounts receivable. Let's assume there is an entity X Limited and the functional currency of this X Limited is INR. This entity has sold products in US, right? And the sale price is, let's assume $10,000. So this entity is going to receive fixed amount of cash, that is $10,000 from its customer, right? So here we can say there is right to receive the fixed amount of cash, and hence this accounts receivable will be considered as monetary assets. Similar provisions will apply on notes receivables, loans given, advances given. These are generally the examples of monetary assets, right? There could be other examples as well. One thing you need to understand that I have written that advances given if refundable. Why I have mentioned if refundable? Because if you have made the advances and you are going to receive any product or service against those advances, then it will become non-monetary, because then you are not having right to receive fixed amount of cash, right? You have the right to receive the product or service. So in this particular scenario, this advance given will become the non-monetary item. But on the other hand, if you have provided advance to any party and you have the right to receive advance back from that party, then and only then advances given will be considered as monetary assets, right? I hope it is clear to you. Second, monetary liability. Again, the definition is same. Monetary liabilities are those liabilities or those items that will be paid out in fixed or determinable amount of cash. Again, the example is accounts payable. Let's assume you have purchased property, plant and equipment, or you have purchased any machinery from the foreign country, right? So you need to pay fixed amount of currency of that particular country to your vendor. So here there is fixed amount and you have the obligation to pay this fixed amount to your foreign vendor. So this amount will be considered as, or this transaction will be considered as monetary liability. right? Similarly, notes payable, bonds payable, leases payable, accruals, all are these the examples of monetary liability. What you need to determine? You need to determine whether you are going to pay fixed amount of cash or not. If answer is yes, then it is monetary liability. If answer is no, then it is non-monetary liability. Next is non-monetary assets. What is the definition of non-monetary assets? Standard says non-monetary assets are those items that will not be received in fixed or determinable amount of cash. For example, inventory. If you are having inventory in your godown on the reporting date, then this is non-monetary assets. Why? Because you are not having right to receive cash from your customer. Why? Because you have not sold this inventory to your customer. It is lying with you. And hence, if you are not having right to receive fixed amount of cash, we can say this is non-monetary assets. Second example is prepaid expenses. Let's assume you have paid 1 lakh rupees advance for a period of 5 years to receive AMC service, right? Now, this advance, I told you, cannot be considered as monetary item. Why? Because you are required to recognize this advance as prepaid expense and you are going to receive service against this advance, right? So this advance will take the color of prepaid expense and it will become the non-monetary item because you are not having right to receive the advance back. Although that is different thing if the counterparty has breached any provisions of the contract and then advance has become refundable. In that particular scenario, we can say this advance is monetary item. Otherwise, advances will always be non-monetary items, right? Next example is equity securities. If the entities have received capital from its promoters, from its shareholders, then this equity security is non-monetary in nature. Why? Because entity does not have any obligation to pay back this security to equity shareholders. Although at the time of liquidation, someone may argue that at the time of liquidation, this equity is required to be repaid to the equity shareholders, right? But that is exceptional case. That equity is required to be repaid only and only in the case of liquidation. If there is no liquidation, then the entity does not have any obligation to pay equity back to their shareholders, right? And hence equity securities are considered non-monetary in nature. Similarly, investment property, property, plant and equipment, intangible asset, all these are the examples of non-monetary items. Why? Because you have not sold your investment property or PPE or intangible asset to any party. Once you sell these items to your customer and the customer has become your trade receivable or other receivable, then you can say, okay, I am having the right to receive the fixed amount of cash. And then this will take the color of monetary assets. Otherwise, all these items are the examples of non-monetary assets. Next is non-monetary liabilities. What is non-monetary liabilities? Standard says these are those items that will not be paid out in fixed or determinable amount of cash. For example, deferred income. What is the meaning of deferred income? In AS era, we say advance from customer. In Ind AS era, we say deferred income. This is nothing but the advance from customer. Now, this is the reverse situation. Instead of providing advance, you have received advance from your customer, right? Now, let's evaluate. You are not going to refund back this advance to your customer. Rather, you are going to provide services or you are going to deliver product to your customer, right? And hence, this is non-monetary in nature. But in contrast, if you have breached any provisions of the contract, as a result, this advance from customer has become refundable to the customer. Then we can say now this advance from customer has taken the color of monetary items. Why? Because we need to refund this advance to the customer because we have breached the contracts of we have breached the provisions of the contract. Otherwise, in each and every scenario, advance from customer will be considered as non-monetary liabilities. Next example is government grant. Now let's assume your entity has received government grant, which is required to be recognized as per the provisions of Ind AS 20. So what journal entry you will pass in your books of account? Bank account debit to government grant liability. And as and when you satisfy the conditions attached to the grant, you will amortize this grant over the period in the P&L account. Now, whether you are going to amortize this grant over the period or at a point in time, again, it will depend on the conditions attached with the grant, right? So if the grant is required to be amortized over a period, so you have recognized the liability with respect to this grant. And since this grant is not refundable to the government, and hence it will be considered as non-monetary liability. But I'm applying the same provisions. If you have breached any conditions or any provisions of the grant, then this grant will become the refundable to the government, and then this will take the color of monetary items. So in nutshell, we can say all those items where we are going to either receive cash or we are going to pay cash in a fixed amount or in a determinable amount, those are the examples of monetary items. And where we are not going to receive or we are not going to pay fixed amount of cash or determinable amount of cash, then we can say these are the examples of non-monetary liabilities. Now we need to account for monetary items and non-monetary items as per the provisions of Ind AS 21. So we are going to discuss about the recognition criteria on initial measurement. Now, let me clarify you one thing, whether it is monetary item or it is non-monetary item, it doesn't matter on initial measurement, but it matters on subsequent measurement. That is why we have identified whether it is monetary item or it is non-monetary item. On initial measurement date, it doesn't matter, but on subsequent recognition, it matters, right? So standard says foreign currency transaction is a transaction that is denominated or requires settlement in foreign currency. Transaction is to be recorded initially by applying the foreign currency amount at spot exchange rate between the foreign currency and the functional currency at the date of transaction. Let's assume I have sold my products on 1st of January 2025 in US. So I need to identify what was the spot exchange rate on 1st of January 2025. Let's assume the sale price is $10,000 and let's assume the spot exchange rate was 85 on 1st January 2025. So I need to record this transaction at a rate of 85 and I will multiply 10,000 by 85 and it will become 8,50,000 rupees. So I will pass one simple journal entry in my books of account, trade receivable account debit to sales by 8,50,000 rupees, right? So you are required to identify the spot exchange rate of the date of transactions. But standard further says for practical reasons, a rate that approximates the actual rate at the date of transaction is often used. For example, an average rate for a week or month. If you are doing a lot of transactions, you are doing a lot of exports, imports during the week or during the month or during the quarter, then you can consider the average rate of that particular week or month or quarter. But you need to be cautious that there should not be significant fluctuation in the average rate that has been considered to recognize the entry in the books of account. If there is significant fluctuation in the rate between these two currencies, then average rate cannot be considered and you will have to consider the spot exchange rate on the date of transaction. So these provisions are regarding the initial measurement of monetary and non-monetary items, and there is no difference with respect to recognition on initial measurement date, right? Difference arises in case of subsequent measurement. If you are having monetary item, then what you need to do? You need to consider the rate at the reporting date, right? If there is a listed entity, then the rate of 30th June, 30th September, 31st December, and 31st March can be considered. If it is an unlisted entity, then rate of 31st March can be considered only for monetary items, right? So basically, in nutshell, what I am trying to say, on each reporting date, you are required to reinstate your monetary items, correct? On the basis of the spot exchange rate of reporting date. If you talk about the non-monetary items at historical cost, means non-monetary items are not required to be remeasured. You can see here, it has been clearly mentioned that the rate at the date of transaction will be considered for the purpose of subsequent measurement. It means non-monetary items would remain at the same cost. It will be recognized only and only at historical cost, right? For example, you have purchased PPE on 1st of January 2025. So you have recognized that PPE in your books of account, and let's assume you have purchased this PPE from foreign country. So what you will do, you will consider the spot exchange rate between these two countries. Let's assume the functional currency of your entity is INR and you have purchased this PPE from US, so US dollar will become your foreign currency. What you will do, you will consider the spot exchange rate between these two currencies on 1st of January 2025 and you will record PPE in your books of account. Now on 31st March 2025, you are not required to do anything. Why? Because standard does not want to reinstate the non-monetary items. But there is catch here. Ind AS 21 does not require to reinstate the non-monetary items, but it is quite possible that you can do the revaluation as per the provisions of Ind AS 16. This is permissible, right? Ind AS 16 permits you to record your PPE either at cost model or revaluation model. Although you are not required to do the revaluation on the basis of Ind AS 21, but you can do the revaluation as on the basis of Ind AS 16. Similarly, if you have made the investment in equity shares, right? Investment in equity shares is again the example of non-monetary asset because you have not sold your shares to any customer, right? These shares are laying with you. So investment in equity shares is the example of non-monetary items, right? And these non-monetary items are not required to be remeasured. But here Ind AS 109 comes into the picture. Provisions of Ind AS 109 says investment in equity shares can be measured either at FVT-OCI option or FVTPL option, right? So by doing so, you will be able to reinstate your non-monetary items as well. Now, please let me know, is my Excel file is visible? Kapil, is my Excel file is visible?
Yes, Paras is
visible. Okay. So let's understand these two concepts with the help of few simple examples. Let's assume there is entity X Limited, which is an Indian entity, and the functional currency of this entity is INR. This entity has sold goods on 1st of January 2025 to Y Limited, right? And Y Limited is an US entity. The rate, or you can say the sale price is $1,000 and the rate on the date of sale is 85 rupees. So 85 rupees is the spot rate on the date of transaction, right? Now we need to pass journal entry in the books of X Limited. So how we will account for this initial recognition in the books of X Limited? We will record trade receivables account debit to sales, and what will be the value? 85,000 rupees. How it has been calculated? 1,000 multiplied by 85. 1,000 is the sale price and 85 is the spot rate on the date of transaction. So it comes to 85,000 rupees. So this journal entry will be recorded by X Limited in its books of account. Now, if you talk about the subsequent recognition, I told you in case of monetary items, you are required to consider the rate at the reporting date, right? And trade receivable is your monetary item because you have the fixed amount which you are gonna receive from Y Limited. Let's assume on 31st March 2025, rate is 87. You have already recognized your trade receivable at the rate of 85, but now the rate is 87. So you are going to receive extra money from your customer. So what you will have to do, you will have to increase your trade receivable by 2 rupees, right? So what journal entry you will pass in this case? Trade receivable account debit to Forex gain, right? Trade receivable account debit to Forex gain. 1,000 is the sale price and 2 rupees is the gain. So you will credit Forex gain in the P&L account. Always remember, in case of monetary items, Forex gain or loss will be charged to profit and loss account. There is no concept of OCI in case of monetary items. I am talking about only monetary items. Okay. Now let's assume today when the rate is 88, Y Limited has paid $1,000 to X Limited. So this is the settlement date. Now what journal entry you will pass in this day, on this date? Bank account debit. What will be the amount? Amount would be 88,000 rupees. How it has been calculated? 1,000 is the sale price and 88 is the spot rate on settlement date. So you will debit your bank account by 88,000 rupees. Then you need to credit your trade receivable by 87,000 rupees, because you have already recognized your trade receivables in your books of account at 87,000 rupees. Again, there is a gain of 1,000 rupees on this settlement date, and this gain will be recognized in P&L account, right? This gain will be recognized in P&L account. So this is all about the monetary items. We have discussed how we will account for the initial recognition and how we will account for subsequent recognition in case of monetary items. Now let's discuss about the non-monetary items. I am taking the same example. There is entity X Limited. Now this time X Limited has purchased the equity shares of Y Limited, which is the US based listed entity, right? Now this is the investment in equity shares on 1st of January 2025. X Limited has purchased equity shares in foreign currency, right? And what is the price? 1,000 is the investment price, and the rate is 85 rupees on 1st of January 2025. So I told you there will not be any difference on the initial recognition, whether it is a case of monetary item or whether it is a case of non-monetary item. So you will pass one simple journal entry in the books of account, investment in equity shares debit to bank. And what is the amount? Amount is 85,000 rupees. 1,000 is the amount of investment, and 85 rupees is the spot rate on the date of transaction, right? Now, Ind AS 21 stops you to recognize or to reinstate the non-monetary items. But I told you here the provisions of Ind AS 109 comes into the picture, and you will have to either recognize your investment in equity shares at FVT OCI option or FVT PL option. Now, someone may argue that investment in equity shares cannot be recognized as FVT OCI. Why? Because it will fail the fourth criteria of SPPI condition. Although I am not going to dive deep into the provisions of Ind AS 109, but it is important to give you the brief background regarding this provision. Then and only then you will be able to understand the provisions of Ind AS 109. So investment in equity shares cannot be classified as FVT OCI. It will always be classified as FVT PL. But there is an irrevocable option which has been provided by Ind AS 109, which says if you have purchased equity shares, you have made the investment in equity shares, and these investments are not held for the purpose of trading, then and only then you can measure your investment in equity shares at FVT OCI option as well, right? So you have the choice. If you want to go for FVT OCI option, you can do so. If you want to go for FVT PL option, you can do so. But if you are holding the investment in equity shares only and only for the purpose of trading, then FVT OCI option is not permissible as per the provisions of Ind AS 109, right? And this is irrevocable options. Once you have selected this option, you will not be able to reclassify your investment in equity shares in P&L account, right? So as per the provisions of Ind AS 109, we need to subsequently account for this investment in equity shares at fair value. Now, whether you want to go for FVT OCI option, whether you want to go for FVT PL option, it is up to you. But you will have to do the fair valuation on the reporting date. Now, let's assume on the reporting date, the rate is 87. And there is also increase in your investment. You made an investment of $1,000 and there is increase of $100 in your investment. So there is fair value gain as well. Now you need to record this transaction in the books of account. So how will you account for this transaction? You will increase your investment in equity shares by what amount? If you multiply by 1100, if you multiply it by 1100 by 87, it comes to 95,700 rupees. But you have already recognized 85,000 rupees in your books of account. So you can increase your investment by 10,700 rupees. You can see here, I have multiplied $1,100 with 87, and I have reduced the cost of investment which I have already recognized in the books of account. So it comes to 10,700 rupees. Now the entire gain of 10,700 rupees cannot be recognized as forex gain. Why? Because forex gain is only for 2 rupees. There is fair value gain as well for $100. So you will have to split this transaction into two ledger. First, FBT OCI, I have chosen FBT OCI option in this case. So what I have done, 100 rupees is the gain on 31st March 2025 and 85 rupees was the spot rate. So it comes to 8,500 rupees, and then I have recognized forex gain in the OCI for 2,200 rupees, right? This is the journal entry which you need to pass here. One point you need to always remember, only and only in case of non-monetary items, whether you will recognize forex gain or loss in the P&L account or in OCI account, it will depend on the option you have chosen. If you have selected FBT OCI option, then always forex gain and loss will be transferred to OCI. But if you have selected FBTPL option, then this forex gain and loss will always be transferred to P&L account, right? Always remember my words. जहां दर्द है वहीं दवा है. घुटने में चोट लगी है तो घुटने में दवाई लगाओगे, हाथ में चोट लगी है तो हाथ में दवाई लगाओगे. जहां पर आपने मेन कंपोनेंट को क्लासिफाई करा है वहीं पर ही आप उसके गेन और लॉस को भी क्लासिफाई करोगे. If you have selected OCI option, you will have to classify your forex gain and loss in OCI. If you have selected FBTPL option, you will have to classify your forex gain or loss in P&L account. This is the concept regarding non-monetary items.
Paras, I think it will be good also to tell the participants that FBTPL is fair value through profit and loss account entry, and yeah. I'm just saying that it will be good to expand this FBTPL and FBT OCI to the audience. So FBTPL is fair value through profit and loss account, and FBT OCI is fair value through other comprehensive income account. So one becomes part of the P&L and other becomes part of the other comprehensive income, which gets reclassified or not reclassified to P&L. Right. Right, Paras, you can continue.
Hello, am I audible?
Yeah.
Hello, am I audible?
Yes, Paras, yes.
Okay. So I was saying, do I need to further explain the concept of OCI?
No, I think it's fine. It's fine. You can continue.
Okay. So let me just brief about the OCI. In OCI, there are two options, right? Option number 1 talks about the items which can never be classified to P&L. And option number 2 talks about the criteria number 2 talks about those items which can be reclassified to P&L account subsequently, right? So the fair value gain or loss on these shares is the item which can never be classified to P&L account, right? So now we need to understand the recognition of exchange differences. Although I have already explained, but let's read the theory part. It says on monetary items, exchange difference arising on the subsequent recognition of monetary items as above or arising on their settlement shall be recognized in profit and loss in the period in which they arise. But in case of non-monetary items, there is bifurcation between two items. First, they say when a gain or loss on non-monetary item is recognized in OCI, that is other comprehensive income, then any exchange component of that gain or loss shall be recognized in OCI. Conversely, when a gain or loss on non-monetary item is recognized in profit or loss, any exchange component of that gain or loss shall be recognized in profit and loss account, right? So you need to first evaluate which option you have selected, and on the basis of that option, you need to classify your exchange difference in the P&L account or in the OCI account. Now let's read example number 3. It says during January 2025, XYZ Limited is an Indian company purchases on credit a machinery from US vendor for $1 lakh. When the exchange rate is INR 85, right? $1 is equal to INR 85. The company records the asset at a cost of 85 lakh. XYZ's year end is at 31st March 2025 and the account has not been settled yet. The closing rate as at 31st March 2025 is $1, which is equal to 85.50. You are required to explain the treatment of above transaction in the books of entity. So as we discussed, what journal entry you will pass in your books of account? PP account debit to creditor for capital goods, right? This creditor for capital goods is a monetary item and hence it is required to be remeasured at closing rate. What is the closing rate? Closing rate is 85.50. So the amounts payable would be retranslated at 85 lakh. Sorry, just give me a second. This amount payable will be recorded at 85 lakh 50,000 rupees and the exchange loss of 50,000 rupees will be charged to profit and loss account, right? And if you talk about the treatment of machinery, since it is a non-monetary item, hence no subsequent changes required. The cost of machinery would remain as INR 85 lakh rupees. I hope it is clear to you. Next, we are going to discuss about the change of functional currency. It is quite possible that after determining the functional currency, there is change in facts, there is change in circumstances, there is change in underlying transactions, and the basis which you will have to change your functional currency. Now the question rises whether you need to change your functional currency on retrospective basis or on prospective basis. So standard will tell you. Standard first says an entity does not have a free choice of functional currency. We have already discussed on the basis of para 9 and para 10, an entity is required to determine its functional currency. Entity does not have any free choice to determine its functional currency on its own basis. Entity will have to apply the provisions of para 9 and para 10 in order to determine the functional currency. Second, they say an entity cannot change functional currency unless there is a change to those underlying transactions, events, and circumstances. So until and unless there is any change in the underlying transaction or event or circumstance, you cannot change your functional currency, right? It will be same forever. Then translation procedures should be applied to new functional currency prospectively from the date of change. Why prospectively? Because you have determined your functional currency correctly on the basis of primary indicators and secondary indicators. There was no error in determining the functional currency. You have not made any kind of error in order to determine the functional currency, right? And hence there is no requirement to do retrospective accounting. Rather, you should go for prospective accounting because this is change due to changes in circumstances and facts. And hence standard allows you to account for this transaction on prospective basis, right? Now let's solve example number 4 to gain more clarity. It says entity A has historically determined its functional currency to be INR as per Ind AS 21. However, as a result of change in circumstances affecting the operations of the entity, management determines that from 1st April 2025, the functional currency of the entity is US dollar. The exchange rate at that date is 1 USD is equal to 85. As at April 1st, 2025, the balance sheet of entity A included equipment with a cost of INR 36,000 and a net book value of INR 16,500. So the gross book value of this equipment is 36,000 and WDV of this equipment is 16,500 on 31st March 2025. With effect from 1st of April 2025, you need to change your functional currency. So question is asking when and how. should a change in functional currency be accounted for as per the provisions of Ind AS 21? So let's see the solution. It says entity A is required to translate the cost and net book value of the equipment into its new functional currency, that is USD, from the date of change, that is 1st of April 2025. Accordingly, the gross book value and the net book value of the equipment being 33,000 and INR 16,500 respectively will be translated at the rate of INR 85. The effect of change in the functional currency is to be accounted for prospectively. It is to be accounted for prospectively, and accordingly, the resultant translated gross book value of USD 388.24 will become the historical cost of equipment, and resultant net book value of USD 194.12 is its revised net book value. So what I have done, I have divided 36,000 by 85 rupees and I have divided 16,500 by 85 rupees. So this is how this value has been calculated in USD. This is the way to translate all the items in case of change in the functional currency. Entire balance sheet will be translated in the same manner, right? And the translation, we know it will be done on a prospective basis because we have not made any kind of error, and hence there is no requirement to do any kind of restatement or present any third columnar balance sheet as per the provisions of Ind AS 8, right? I hope it is clear.
Paras,
Then next, yes.
Paras, just a second.
Sure.
Paras, I think in the first paragraph we have written equipment costing 36,000.
Right.
And in the solution we have converted 33,000. I think it's a typo, right? There is no difference of 3,000.
Yes. Thank you for pointing this out.
No problem,
yes,
no problem,
this value is incorrect. It should be 36,000.
And then
but I hope concept is clear.
Yeah. Absolutely. Thank you.
Okay. Thank you for this pointing out. Okay. Next, we are going to discuss about the translation approach, right? We have already covered the translation of foreign currency to functional currency, how to account for initially and subsequently any foreign currency transaction we have already discussed. Now what we are going to discuss? We are going to discuss about the change in the change from functional currency to presentation currency, or how to translate the financial statements of foreign operation into the presentation currency of reporting entity. And let me clarify you, these procedures are same in case of presentation currency and foreign operation. Means whether you want to change your functional currency to presentation currency, or you want to change the financial statements of your foreign operation from its own functional currency to your presentation currency, means the presentation currency of the reporting entity. The translation procedures are same. So what standard says? First, it says all the assets and liabilities will be translated at closing rate of the balance sheet date. For current period, you will consider closing rate of current period. For comparative period, you will consider the closing rate of comparative period. Now, I have seen a lot of people making mistakes here. What they generally do, they do not reinstate the non-monetary items because they have read non-monetary items are not required to be reinstated. But let me clarify you here. Here you are translating your functional currency to presentation currency. You have already prepared your balance sheet in functional currency. And now what you are going to do, you are going to translate this balance sheet into presentation currency. For example, you have already prepared your financial statements in INR, but you also want to prepare your balance sheet, or you can say the financial statements in US dollar. So you are permitted to do so by the provisions of Ind AS 21, and hence it is important to translate all the line items of balance sheet, whether it is monetary, whether it is non-monetary, doesn't matter. You will have to translate all the assets and all the liabilities at the closing rate, or you can say by using the closing rate of the balance sheet date, right? And similar provisions will apply in case of translation of foreign operations financial statement to the presentation currency of reporting entity, right? Second, equity items. equity items are required to be recorded at the date of transaction only, right? For current period and for comparative period as well. In case of income and expenditure, what you need to do, you need to either consider the actual rate or an appropriate average rate for current period, and similarly for comparative period. If you want to go for actual rates, you are free to do so. If you want to apply average rate of that particular period, you are free to do so, right? But please let me clarify once again here, there should not be significant fluctuation in those rates, right? And now you can see assets and liabilities have been translated by using closing rate. Equity item has been recorded using the rate of the date of transaction, and income and expenditure has been translated by using either the actual rates or the appropriate average rate of that particular period. So there will be delta, there will be balancing figure, and this delta will be considered as exchange difference, and this is commonly known as FCTR, foreign currency translation reserve. And this reserve is required to be disclosed as a separate column, as a separate line item in the component of equity, that is SOCI. SOCI is the short form of statement of changes in equity, right? So you need to disclose this FCTR as a separate line item in the statement of changes in equity. So this is the translation provisions regarding the change from functional currency to presentation currency, or translation of foreign operations financial statement into the presentation currency of the reporting entity. Now we are going to discuss about the intragroup transactions. We all know that while preparing the consolidated financial statements, intragroup transactions are required to be eliminated, right? If the holding company has sold products to the subsidiary company or vice versa, or there is any transaction within the group itself, so in standalone financial statements, these transactions will be reflected. But while preparing the consolidated financial statements, these transactions are required to be eliminated, right? These provisions, we all know that. So what the Ind AS 21 is telling you, Ind AS 21 says, although intragroup balances are eliminated on consolidation, any related foreign exchange gain or loss will not be eliminated. If you have done any transaction with your subsidiary who is situated in, let's assume, US, then this transaction, the principal balance will get eliminated while preparing the consolidated financial statements, but the foreign exchange gain or loss arising on this transaction will not be eliminated. Why so? Standard says this is because the group has a real exposure to the foreign currency, since one of the entities will need to obtain or sell foreign currency in order to settle the obligation or realize the proceeds received, right? There is actual foreign currency exposure from the group's perspective as well, and hence as a result you cannot eliminate the foreign exchange gain or loss which you have recognized in your standalone financial statements, right? Principal transaction will get eliminated, but the forex gain or loss will not be eliminated in the consolidated financial statements. Further, the standard is saying accordingly, in the CFS, that is the consolidated financial statements, the exchange difference arising on such intra-group transactions is recognized in the P&L account, unless, this line is extremely important, unless it arises on a monetary item that form parts of reporting entities' net investment in foreign operation, in which case it is taken to OCI, right, and accumulated in a separate component of equity, that is FCTR, and reclassified to profit or loss on disposal of foreign operation. So what I mean to say, if this is a normal transaction, whether there is any gain or there is any loss, you need to transfer this gain or loss to the profit and loss account, right? This is the normal scenario. But if this is a transaction which is in the nature of net investment in the foreign operation, in that particular scenario, you cannot recognize this gain or loss in the profit and loss account. You will have to recognize this gain or loss in the OCI, that is other comprehensive income. And once once the disposal of foreign operation has been made, then and only then this OCI option, this OCI amount can be reclassified to profit and loss account, right? Now let's solve this example number 5 to gain more clarity. Please read this example very carefully. It says on 1st of April 2021, P Limited, that is a parent entity whose functional currency is INR, made a USD 10,000 loan to its foreign subsidiary, that is S Limited, whose functional currency is USD. The loan bears interest at a market rate payable annually at the end of each reporting period. For the sake of simplicity, it is assumed that the amortized cost of the loan at the end of the reporting period, that is as on 31st March 2022, is USD 10,000. So they have not changed the balance of the loan, right? Although the loan is required to be classified by using the amortized cost approach as per the provisions of Ind AS 109, but they have injected the balance of loan on 31st March 2022. On 1st of April 2021, the rate is USD, 1 USD is equal to INR 74, and on 31st March 2022, 1 USD is equal to INR 75. The question is asking how should exchange difference arising from translation of the said loan receivable be recognized in consolidated financial statements of the entity in each of the following scenarios or in each of the following cases. Scenario number 1, they have mentioned that P Limited does not intend to demand repayment from subsidiary, nor does the subsidiary expects to repay the loan in the foreseeable future. P Limited regards its loan to S Limited as part of its net investment. Why? Because neither the P Limited is going to ask for the money, nor the subsidiary company is going to repay this amount to parent company, right? So this will take the color of net investment in foreign operation. Under scenario number 2, the question has mentioned that P Limited has given loan to subsidiary for a period of 5 years. It expects that the subsidiary will repay the loan back after 5 years. S Limited also intends to repay back the loan. So in scenario number 2, they are treating the loan as a loan transaction. But in scenario number 1, they are treating this loan as an investment. Why? Because neither the holding company is going to ask for the money, nor the subsidiary company has the intention to repay this amount to the holding company. Assuming the parent adopts an accounting policy of recognizing its investment in subsidiary at cost less impairment in its separate financial statements. So what we need to do, we need to disclose how we will account for this exchange gain or loss in the consolidated financial statements. But until and unless we account for this transaction in the standalone books of the holding as well as the subsidiary, we will not be able to understand this transaction. And hence what I have done, I have disclosed this transaction in the separate standalone books of holding and subsidiary as well as in the consolidated financial statements, right? So that you can get the holistic view. First, read the theory part. It says net investment in a foreign operation. An entity may have a monetary item that is receivable from or payable to a foreign operation. An item for which settlement is neither planned nor likely to occur in the foreseeable future is in substance a part of the entity's net investment in that foreign operation. Such monetary items may include long-term receivables or loans, but they do not include trade receivables or trade payables. Accordingly, a loan repayable on demand may be part of the entity's net investment if neither party to the loan intends or expects that the repayment will be made. If any holding company has provided any loan to the subsidiary company or vice versa, which is repayable on demand, right? And if neither of the party has the intention to repay or to receive this money back, then this loan can be considered as investment in the holding, investment in the subsidiary company, right? So let's solve this case study as per scenario number 1. in separate financial statements of parent, what you will do, you will recognize the loan receivable, right? And this loan receivable will be recognized at a value of 7,40,000 rupees. How it has been calculated? 10,000 is the USD amount and 74 is the rate on the date of transaction, right? This is the spot rate on 1st of April 2021 when this transaction occurred. So the parent company is required to recognize this loan in its separate financial statement at a value of 7,40,000 rupees. Now, since this loan is a monetary item, right? Although this loan has taken a color of investment only for the purpose of accounting in the consolidated financial statements, but this loan is monetary in nature and hence this loan is required to be remeasured at the rate of the reporting date, right? So on reporting date, the value is 75, $1 is equal to 75. So holding company is required to recognize a gain of 10,000 rupees, which will be disclosed in the P&L account, right? Now, what journal entry will be passed in the books of subsidiary? Subsidiary will recognize the borrowing in its books of account. So on initial recognition, this loan will be recognized at USD $10,000. Now, please pay attention here. I have assumed that the functional currency of the subsidiary is not same as that of the reporting entity, and hence this entity is required to record this transaction at $10,000 because subsidiary company is required to repay $10,000 to holding company. Although in scenario number 1, we are assuming this amount is never going to be paid back by the subsidiary company to the parent, but this transaction will be recorded at $10,000. Subsequent recognition, there is no requirement to do subsequent recognition. Why? Because the subsidiary company has already recorded this transaction at functional currency. And since the transaction has already been recorded at the functional currency, there is no requirement to do the subsequent recognition because this is not a foreign currency transaction in the books of subsidiary. Now let's evaluate what the parent will do in the consolidated financial statements. Exchange gain of INR 10,000 will be transferred to OCI. Now please pay attention here. In the separate financial statements, the holding company has recognized this gain in P&L. But in the consolidated financial statements, this gain is required to be transferred from P&L to OCI. Why? Because this is the transaction which is in the nature of investment in foreign operation. And Ind AS 21 specifically says if there is a investment which is in the nature of investment in foreign operation, then this gain or loss is required to be transferred to OCI in case of consolidated financial statements, right? This is the solution for scenario number 1. Now, if you read the scenario number 2, in the separate financial statements of parent entity, initial and subsequent recognition will be same as per scenario number 1. In the separate financial statements of subsidiary, initial and subsequent recognition will be same as per scenario number 1, right? But in the consolidated financial statements of holding company, or you can say in the consolidated financial statements of group, this gain will be recognized in the P&L account only. You cannot transfer this gain to OCI account, right? Why? Because in scenario number 2, we have assumed that holding company is going to receive this money and the subsidiary company is also going to repay this money back to holding company, right? So in scenario number 2, we have assumed this transaction as a loan transaction. However, in scenario number 1, we have assumed this transaction as an investment transaction, right? I hope it is clear. Now, we need to discuss about the disclosure parts. What are the disclosures requirements of Ind AS 21? First, you need to disclose the amount of exchange difference recognized in profit and loss, except for those arising on the financial instrument at FVTPL in accordance with Ind AS 109. So we have already excluded provisions of Ind AS 109, derivative transactions, hedge accounting, all those are not covered under Ind AS 21. And hence you are required to disclose only the exchange difference which has been generated as per the provisions of Ind AS 21. Second, you need to disclose the net exchange differences recognized in OCI and accumulated in separate component of equity. along with the reconciliation of amount at the beginning and end of the period. So what you need to do, you need to disclose the movement of the net exchange difference recognized in the OCI. Third, they are saying when the presentation currency is different from the functional currency, that fact shall be stated in the notes to accounts together with the disclosure of functional currency and the reason of using the different presentation currency. Let's assume there is entity X Limited which has the functional currency INR. So this entity X is required to prepare its financial statements using its functional currency, which is INR. If this entity wants to present its financial statements in US dollar, it is free to do so, but this entity is required to state such facts in the notes to accounts why this entity has chosen this option to present its financial statements in US dollar as well, right? So whenever you are having a presentation currency which is different from the functional currency, then you need to disclose the facts along with the reasons why you are choosing a different presentation currency. Further, they are saying in case of change in the functional currency of either of the reporting entity or a significant foreign operation, you need to disclose the facts of the change, reason for the change, and the date of change in the functional currency. Why date is important? Because you are going to account for this transaction on prospective basis, right? And hence standard is asking specifically you need to disclose the date from which date you have considered a different functional currency, right? And in last, they are saying if presentation currency is different from the functional currency, the financial statements can be described as complying with Ind AS only if all Ind AS, including the translation method of this standard, is complied with. So in last, you need to disclose when the presentation currency is different from the functional currency, whether your financial statements are Ind AS compliant or not. This is regarding the disclosure requirement. Now we have reached to an end. We need to discuss the GAAP difference between IAS 21 and Ind AS 21. So let me clarify you here. There is no significant GAAP difference between the provisions of IAS 21 and Ind AS 21. Right? There is insignificant difference which is regarding the notes to accounts. So we can say in nutshell, both the standards are aligned. So what I am going to do, I am going to discuss the key difference between AS 11 and Ind AS 21. Right? So first difference is regarding the forward exchange contract. So I told you when I began this standard that there is derivative transaction which is outside the scope of Ind AS 21. Why? Because we are having a separate standard in Ind AS, which is Ind AS 109, which deals with such kind of transactions. But in AS era, there is no financial instrument chapter. There is no Ind AS 32 or 109 which talks about such kind of transactions, and hence forward contracts are included in AS 11 itself. Second, approach for translation. If you have read the provisions of AS 11, you must be aware that there is concept of integral foreign operation and non-integral foreign operation, right, in AS. But in AS, there is no concept of integral operation or non-integral operation. What is the concept here? The concept talks about the significant degree of autonomy. You need to check whether your foreign operation is conducting its business independently or not. If it is doing its business independently, then you need to determine the functional currency on the basis of para 9 and 11, para 9 and para 10. But if the foreign operation does not have significant degree of autonomy, means it is not independent, then we can assume the functional currency of the reporting entity is same as that of foreign operation, right? Third point, presentation currency. Again, AS 11 is silent on this aspect. Right, I gave you the example of X Limited. If there is X Limited which is registered under Companies Act and which is carrying out its business in India, it is assumed that the functional currency of this entity is INR and this entity will prepare its financial statements in INR only. But Ind AS 21 allows the entity to present its financial statements in any other currency which is different from the functional currency if the entity wants to do so, right? So there is a concept of presentation currency as well. Now, last point talks about the para 46 and para 46A of AS11, right? Before reading this theory, let's understand this concept with the help of one simple example, and then we will discuss the gap difference. Let's assume there is entity X Limited, which is registered in India, and functional currency of this entity is INR, right? This entity has taken a loan in year 2025 for $1 lakh, right? And let's assume the period is 25 years. Period is 25 years. So this is long-term monetary item, right? This is loan and this is monetary item, and the loan has been taken for 25 years. So this is long-term monetary item, right? When para 46 and 46A were not introduced in AS11, what was the provision? Entity was required to reinstate its monetary items, and exchange gain or loss was required to be transferred to profit and loss account, right? I am talking about the era when provisions of 46 and 46A were not introduced in AS11. So entities were required to transfer their exchange gain or loss in profit and loss account. But what happened in 2008? Then financial crisis hit. A lot of entities filed petition with the MCA, and MCA heard them, and they asked to defer this gain or loss to the balance sheet. They want to defer this exchange gain or loss. Why? Because it is impacting their profit and loss account. There was huge loss in 2008, 2009, 2010, and hence MCA allowed them to carry forward this exchange gain or loss in the balance sheet, and MCA provided them an option. So two options were there. First option was original, that is forex gain or loss can be transferred to P&L account, right? But MCA provided them one irrevocable option. What is the meaning of irrevocable option? If option number 2 is selected, you cannot go back and you cannot transfer this gain or loss to the P&L account. You will have to defer this exchange gain or loss to the balance sheet. So MCA told them, if first of all you need to check whether you have taken this loan for general purpose or for any depreciable asset. If this loan was taken for general purpose, then this gain or loss was required to be transferred in an account which is generally or commonly known as FCMI TDA account, which is foreign currency monetary items translation difference account. And the exchange gain or loss will be transferred to this account, which will be deferred, which will be disclosed in the balance sheet. And this item or this exchange gain or loss can be amortized over the loan tenure. This is regarding the general purpose loan. But if the loan has been taken for depreciable asset, what the entity was required to do? Entity can add or reduce the entity can reduce or add the cost. Entity can add or reduce the exchange gain or loss to the cost of PPE, and it will get automatically adjusted in the form of depreciation. If you have transferred your exchange gain or loss to the cost of PPE, whether it is positive, whether it is negative, it will get automatically adjusted in the form of depreciation. This was the original provision which have been provided in AS11, para 46 and para 46A. Now let's understand what is the gap difference. Now, if such foreign exchange item is there, so first you need to check whether it is relating to any long-term foreign currency monetary items or not. I have taken the example of loan. Loan is the foreign currency, or you can say monetary item, long-term monetary item. So you need to check whether you have the existing loan on the date of balance sheet. If answer is yes, then you have the two options. If you have already chosen para 46 or para 46A as per the provisions of AS, and now you are preparing your balance sheet as per the provisions of Ind AS 21, then you have the two options. Either you can continue with the previous GAAP policy, means you can keep recognizing, you can keep deferring this amount to the either FCMI TD account or to the cost of PPE. Or if you want, you cannot if you do not want to continue with the previous GAAP policy, you can do so. You can transfer the balance to the P&L account. So two options are available. If you want to go for previous GAAP policy, you are free to do so. If you do not want to defer this exchange gain or loss, you are free to do so. You can transfer this exchange gain or loss to the P&L account, right? This is regarding the existing loan. But for those loans which you have taken in Ind AS era, or for those loans where you didn't select the option of carried forward of this balance, right? In that scenario, what you will have to do, you will have to apply the provisions of Ind AS 21 only. So what does it mean? If you have taken any new loan, or there is an old loan, but you have not selected para 46 and 46A. So now in Ind AS era, you are not permitted to select this option again. You will have to classify your exchange difference or loss in your profit and loss account, right? You do not have the option to carry forward the previous GAAP policy. Why? Because either you didn't choose that or you are taking a new loan, right? So this is regarding foreign exchange item. There is one more GAAP difference which talks about the FCTR, right? Now let's assume there is entity X Limited again, and this entity was preparing its financial statements as per the provisions of AS till 31st March 2024, right? On 31st March 2024, the net worth of this entity exceeded 250 crore rupees, and hence this entity is required to prepare its financial statements by applying the provisions of Ind AS with effect from 1st of April 2024, right? Which is the next day. So for this entity, the current period would be financial year 2024-25. Now this entity is required to prepare its financial statement for previous period as well. Comparatives are also required to be disclosed, right? Comparative numbers are also required to be disclosed. So this entity will have to prepare its financial statements for previous year in Ind AS as well. Now one more balance sheet is required to be prepared, which would be for at the beginning of the earliest period presented, right? So as per my example, on 1st of April 2023, one more balance sheet is required to be prepared. Now, let's assume this entity is having foreign operation and hence FCTR is there in its balance sheet, correct? Now, the standard gives you option, either if you want to reset this FCTR as nil, you can do so, or if you want to apply the provisions of Ind AS 21 retrospectively, you can do so. Here, previous GAAP value will not be allowed. You cannot continue with the previous GAAP policy, right? Deemed cost model is not permissible in this case. Either you will have to set your FCTR as nil, or you will have to apply the provisions of Ind AS 21 retrospectively. This is all about Ind AS 21 and AS 11. Now let's read the para 46, the GAAP difference regarding the para 46 and 46A. First, let's read the provisions of AS 11. AS 11 says it gives an option to recognize exchange differences arising on translation of certain non-monetary items from foreign currency to functional currency directly in equity to be transferred to profit or loss over the life of the relevant liability or asset, is such items are not related for the acquisition of PPE. Where such items are related to acquisition of PPE, the foreign exchange difference can be recognized as part of the cost of the PPE. So if you have taken the loan for the purpose of working capital need or for any purpose other than the acquisition of the asset, then what you can do, you can defer this amount to FCMI TDA account. But if you have taken the loan for the purpose of acquisition of the asset, then you can reduce or you can add the value of the PPE, right? Next, this is in Ind AS 21. Ind AS 21 does not apply to long-term foreign currency monetary items recognized in FS, that is financial statements, from the beginning of the first Ind AS financial reporting period. However, as provided in Ind AS 101, such an entity may continue to apply accounting policies so opted for such long-term monetary items as per the previous GAAP. So if anyone wants to continue with the previous GAAP, it is free to do so. If anyone does not want to go for the previous GAAP policy, it is free to do so. So this is it from my side. That's all I wanted to say. Now over to you, Kapilji.
Thanks, Paras, for the wonderful session, and I know that it has been a difficult topic where many where it is very difficult to explain to anyone, and I think it is fantastic that you covered the theory part with the underlying examples, both from the presentation mode also, and more impressingly in the Excel format, which I personally feel that made it quite easier for the listeners audience to understand that in greater detail. So
thank you so much.
This was really very helpful, Paras, for sure, and I know it's a complicated topic, and you have covered so many things in such a short span of time. Yeah. And clearly with the examples you picked up were very nice and nicely drawn and picked up. So thanks, Paras, for this. And I expected
and I thank everyone for their patience.
So I expected, Paras. I think we have a lot of questions. Yes. I'll try to cover, and I mean, because the topic is so very exciting, and I think you explained it so very well also. And I'll try to cover as many as we can, looking at the overall timelines we have on this.
Sure.
Right. So the first question is that and I think some of the questions, Paras, I feel you covered as part of your presentation also, but I'm maybe asking those again for the benefit because of the.
No worries. Go ahead. Please go ahead.
So first is that for foreign branch, how should the transactions be reported during the consolidation with Indian parent?
So as I said, first you need to determine whether the branch is working independently or not. Practically and generally, branch does not operate independently. I have seen in 99% cases, but I will not comment that in each scenario, branch will be working as dependent entity of the reporting entity. So you need to first evaluate by applying the provisions of para 11, whether the branch is having significant degree of autonomy or not. If the branch is working independently, then you will have to determine the functional currency of the branch by applying the provisions of para 9 and para 10. And then you will have to translate the financial statements of branch into the presentation currency of the reporting entity. And if the branch is having the same functional currency as that of the reporting entity, then there is no question for translation.
Right. And if it is under Ind AS 11, then we'll have to ensure whether it's an integrally operated branch or not.
Absolutely correct. Absolutely correct.
Okay, perfect. The next question, Paras, is that should we apply average rate and closing rate for branch accounts, or should we apply transaction rate?
So as I said, it depends. You need to evaluate whether there is any significant difference between those rates. If there is no significant difference, then you can apply the average rate for that particular week or month or quarter, as I said. And if there is significant difference, then you will have to go for spot rate of the transaction date. So there could not be a single answer of this question.
Right. Thanks, Paras. Okay, the next question is that if a company manufactures in India, sells domestically in INR, but basis price on USD denominated international commodity rates influenced heavily by China demand, which currency most likely be its functional currency? How would conflicting primary indicators under India's 21 be resolved in such a case? So I think you picked up quite a similar example in your presentation also.
Right. So first, weightage is required to be given to the sale price, the currency which is influencing the sale price, but you need to evaluate remaining criteria as well. I told you the 5 parameters under para 9 and para 10. So if it is if the price of China or US is influencing the price of the Indian entity, then you will have to evaluate the other parameters as well. Whether your operating expenditures are being incurred in INR, whether you are arranging the funds in INR, whether you are maintaining your working capital needs in INR. If all these parameters are getting satisfied, then you can say the INR is the functional currency of the entity, right? But you will have to evaluate and you will have to dive deep into the all facts.
The 5 factors analysis, out of which
Absolutely.
if 3 get satisfied, then you will decide that
yes,
is the underlying currency. Okay.
But weightage must be given to sale price.
Okay.
Much weightage must be given to sale price.
Next question is that when multiple exchange rates are legally available, that is RBI reference rate or your bank's TT buying rate or selling rate, TTSR, TTBR, what factors should guide the entity in selecting the rate for initial recognition, and can different rates be used for different transactions types under India's 21?
So this is an excellent question, I would say. So you need to consider the rate through which you are going to translate your foreign currency. Let's assume you are having all your transactions with HDFC Bank, right? HDFC Bank rate is also available and RBI rate is also available. So the HDFC rate is going to impact your actual transactions. So personally, I would recommend you should go for HDFC Bank rate, right? Because you are going to deal with such transaction by using the rate of HDFC Bank, right? So the bank in which you are dealing or through which you are going to convert your foreign currency into your functional currency, you should go for that rate. But if the rate is not available, then you can go for RBI rate.
Okay. Yeah, makes sense. That's right. Next question is, if a company's functional currency changes from INR to US dollar on 1st April 2025, how should it treat the carrying amount of its non-monetary asset? Should the original foreign currency transaction date rate be used, or should the closing rate on the change date, on the date of change?
This is the exact question. I gave the example. This is the exact question, right? I divided the INR rate with the US dollar price with effect from 1st of April 2025 when you are changing your functional currency. So
on
you
the date
need
of
to
change, the rate on the
right
date of change.
with effect from the date when you are going to change your functional currency, you will have to consider the rate of that particular date.
Right. Next is can an entity have one functional currency for statutory standalone financial statements? I mean, as per the local Companies Act requirement, and another functional currency for group reporting purposes?
No. So functional currency cannot be two. It should be one, and the entity is required to prepare its financial statements on a mandatory basis in the functional currency only. If the entity wants to present its financial statements in any other currency, entity is free to do so. Let's assume there is X Limited, as I said, and functional currency of this X Limited is US dollar, right? Now this X Limited is required to prepare its financial statements in functional currency only, but this X Limited is required to file their income tax return as well, GST return as well, right? It needs to file its financial statement with MC as well. And for that purpose, it can convert its financial statement from functional currency to presentation currency. That could be INR in this case, right? But functional currency would be one.
Okay. Right. Next question is that what should be the accounting treatment as per India's 21 for goodwill and gain on bargain purchase?
Okay, another excellent question. So let's assume, again, let's take the example of X Limited. There is X Limited, which is an Indian entity, and the functional currency of this entity is INR, right? Now let's assume this entity has acquired the business in US. Right, so that another company has become the subsidiary of this X Limited. Let's assume there is Y Limited, and this X Limited has acquired the business of Y Limited on 1st of January 2025. Right, now here the role of Ind AS 103 comes into the picture. First of all, goodwill or gain or bargain purchase is required to be calculated in foreign currency because you have made an foreign investment, right? So you need to check how much amount you have paid as purchase consideration and what is the value of net assets which you have acquired. If there is goodwill, then goodwill is non-monetary item and it is required to be translated by using the rate of spot rate. And on 31st March 2025, you will translate the balance sheet of the foreign operation using the closing rate of the reporting date, right? So goodwill will be ultimately converted by using the spot rate of the reporting date, that is 31st March in our case. But on the other hand, if let's assume instead of goodwill, there is gain on bargain purchase, right? Then what you will have to do, gain on bargain purchase is in the nature of reserve. You will have to transfer this balance to OCI, right? Because you have paid less amount and you have received more assets, right? So this gain on bargain purchase will always be disclosed by using the rate of the date of transaction. Why? Because this is the equity item. So when I disclose the translation procedures, here I disclose that equity items are required to be disclosed by using the rate of the date of transaction. So gain on bargain purchase is the item which is in the nature of equity, and hence it will be disclosed as by using the rate of date of transaction. But on the other hand, goodwill will be translated using the closing rate of the current balance sheet date. So this is the difference between these two items with respect to Ind AS 21.
Right. Okay. Thanks. Next question is that I think it's important for the professional like us who are in practice. From an auditor's perspective, what are the red flags to watch for in foreign currency accounting? I mean, the transactions related to foreign exchange.
Absolutely right.
The auditing.
So first of all, auditor needs to check whether the entity has identified its functional currency correctly or not, right? Auditor should focus on para 9 and para 10, and auditor should document it on which basis entity has determined its functional currency. This is point number 1. Now, apart from functional currencies, all the currencies will become the foreign currency of the reporting entity, right? So the auditor should check whether the monetary items have been translated using the reporting rate of the balance sheet, right? And whether non-monetary items which are required to be reinstated on the basis of their particular standard. For example, inventory. For example, PPE. For example, investment property. For example, 109, investment in equity shares, right? So auditor needs to check, although Ind AS 21 does not ask for do the restatement for non-monetary items, but whether there is any particular standard which is asking for the revaluation on the reporting date. If so, then auditor should check whether the entity has correctly accounted for this transaction in the books of account or not. And in case of foreign operation, again, auditors needs to check whether the entity has applied para 11 first before applying the provisions of para 9 and 10, and whether there is significant degree of autonomy or not. If there is significant degree of autonomy, then auditor can assume that the functional currency of the reporting foreign operation will be same as of the reporting entity. So these are the points which auditor needs to evaluate and document it properly.
Very good. Next is that maybe this is the last question the time will permit us, Paras. And
sure.
Then I'll request Rahul to take it over from us. So the last question is whether reclassification of FCTR into P&L is possible if subsidiary is fully or partially disposed of.
Okay, again, important question. And this question pertains to Ind AS 110 as well. First of all, you need to check whether you are going to lose your control in the subsidiary or not. Let's assume you have acquired 80% stake in the another entity, right? So another entity has become the subsidiary of the reporting entity. Now, if you are selling, let's assume 60% stake in the another entity. So the other entity will not be subsidiary of your reporting entity anymore, right? In this case, you are losing control, and the balance which is laying in the FCTR account can be reclassified to profit and loss account. But in contrast, if the reporting entity is not losing the control, let's assume out of 80%, only 20% stake has been sold by the reporting entity to any other party, right? In this case, stake is still there, control is still there. Reporting entities having 60% stake in this subsidiary. So in that case, you cannot reclassify that balance into the P&L account. In that particular scenario, you will have to adjust this balance in the NCI account, because now you are increasing your NCI. Earlier NCI were 20%, now the NCI will be 40%.
Understood.
So in this scenario, you will have to adjust your NCI.
Fantastic, fantastic, Paras, and thanks for answering so many questions so very accurately. So thanks, Paras, and Rahul. I'll now request you to just give thanks to Paras and close the session.
Rahul, are you there?
Hello.
Yes, you are audible.
Yes, sir.
Yes, sir. I was just requesting you to give thanks to Paras for the session and close today's session.
Yes, sir. It was a wonderful session. Thank you.
Okay.
Okay,
Thanks.
I think we can wrap up this call.
Yeah. So thanks, Paras, and thanks to all the listeners and audience and fellow friends and colleagues. And I hope you would have liked the session and gained a lot of knowledge from it. And you may feel free to reach out to ASP team of ICI for any further questions you may have on the same. And also the email ID of Paras is displayed on the screen, so you may write to Paras as well. And we'll try to answer your additional questions if any. Thank you.
Thanks, everyone.
Bye.
Bye. Yes. Sorry.